and we want to measure the herding behavior during the extreme market conditions. So how do we define extreme market conditions? Right, our own parameters of defining extreme market condition is these three cutoffs: 1%, 5%, 10%. Let's go through this and try to get on top of this. Extreme market conditions are defined as those lie below the cutoff points, in the lower tail, and above that in the upper tail of the market current distribution. Right? When you earn, let's say you have in time series pattern, let's say you have 500 days and you have calculated every single day's return. Right? Then you see that which are those days when the return was maximum. Right? And which are those when it was minimum. And then Excel helps you with no time, you can get that chronological order also of return. And then you find out, pick those observations which comes as top 1% or bottom 1%, top 5%, bottom 5%, top 10%, bottom 10%, and so on and so forth. Right, to test the herding in extreme market conditions, this equation is applied. So what we've done here is, we have tagged a couple of dummies here. Right, and these two dummies are, we give the value of 1, let's say DEL. L stands for when the market is going. If the market return basically lies in the extreme lower tail of the distribution and equal to 0 otherwise. So we put dummy for the extreme market condition for both up market and the low markets. Are you feeling sleepy? Right. And then not only up and down, then we've seen if market continuously goes up for X number of trading days, or continuously comes down for X number of trading days, does herding exist at that time? So that is kind of a abnormality in the market behavior. So what you've done is the measure of herding during increasing and decreasing markets. Following equation used, again, we have used dummies, this is a different equation, down market, up market, so we have taken the market returns square to represent, make it out again the same that the herding here exists or doesn't exist. So this lambdas are nothing but the proportion if we will put to return, and if we put return time t when the market decreases down and upwards when the market goes down. Relax. Try to digest. Don't jump. Try to enjoy every single slide. Right? Just think that you're watching some Shah Rukh Khan movie, whatever it is. So that's equivalent to that. Rather, it's easier to understand this rather than some latest movie things. Then doing high and low trading volume. As I mentioned earlier, that there's action in volume. Right? And volume always tells you a different story. At times, volume cocks the investor. At times, volume makes the investor more cautious. At times, volume motivates the investor. It means there is something in the volume. So let's check the market's volume is abnormal. How does the herding behavior or how the herding behavior takes place? Whether it takes place or not. Right, so high volume is defined as trading volume day T is greater than its last 30 days moving average. How we define high volume? Take last 30 days moving average, and if on 31st day the volume of that is higher than the average of moving average last 30 days, it means the volume is higher than that day, and vice versa, as simple as it is. Right, so I won't go in detail about the regression. Let's see what we've done here in terms of data. We've collected from 300 top firms in Shanghai A shares, and we have picked BSE 500. From BSE 500, again we have picked top 300 firms from the Bombay Stock Exchange. We have picked daily and weekly stock prices and the volume of last 10 years from 1999 to 2009. What our result says, this is not even descriptive stats, and descriptive stats talks about mean, median, standard deviation, blah blah. So the aspect is nothing but the Shanghai Stock Exchange, Bombay Stock Exchange. Right? So these two observations on the left hand side, I'll say, for the daily CSAD, daily cross section absolute deviation, and the right hand side for the weekly observations. Just see the yellow figures here, whatever the white, they're pretty much black and white. The mean of Shanghai was 0.415 and of BSE was 0.25. Median was this. Standard deviation is pretty much similar, slightly more of the BSE. This was the case of the daily observation. When we try to figure out herding by taking weekly observations, things are a bit different here. Our means are there, medians are there, standard deviation is there, and also the econometrics tests are there like Dickey-Fuller test, John-Ferrer test. I won't go into all these sort of tests. One summary says, summary of these tests or this particular table of descriptive stats, by using both mean and median, the average CSAT based on weekly is higher than based on the daily data. Right? That's pretty much you can find from here. That's the weekly observations and the daily observations. That's what I'm saying here. These results are consistent with the finding of 10, and the paper was saying that herding is less likely to be present based on weekly data. Now here's a question for you, which I hope everybody can understand, everybody can give me a right answer. And the question is, what is the rationale? Should everybody's right now? I should always ask you. What is the rationale that herding exists in, just read these 2.1 line. What do you think? Why does herding exist in daily observation, daily data, but not in weekly? Give it a guess, give it a try. Right, wrong, doesn't matter. Even if it's wrong, I might know. Very good. Why does herding exist from our point of view once we take daily observations? Once we study the market return every day, vis-a-vis when we study market returns every week. 30 seconds given to you to think about this.
There is a sentiment, like market sentiment. And when we talk about the weekly, herd mentality does not, it operates in daily return because there is a market sentiment operate. But when we talk about week, it's an average of what we have done in whole week.
Correct. Correct. I agree. Something else, yes please.
But I think that humor and sentiment is for a very short time. And this is why forward.
Very right. Absolutely right. Anybody else wants to add something?
That's what I want to say, that human behavior, it is so uncertain. Keep on changing within a minute. So instead of weekly, we should have to do daily.
Okay, right. So all of you believes that it makes more sense to digest that if at all herding exists, it should exist in the daily data, so daily observation rather than weekly. Right? Those who herd, they always see what happened today to the market. Right? So on the basis of that, day by day, they make their investment decisions. So the weekly returns become a bit stale from herding point of view. They are useful for some other perspective, but from herding perspective, they become a bit stale. So the action is more in the daily returns. Now this is this market is daily, but if you are with forex markets, right? And if you try to create some time series pattern of forex markets, the observation you will get even minute by minute, even at the interval 30 seconds, tick by tick data. That's what every single transaction is doing. And sometimes in forex market, 5 minutes is too late. If arbitrage opportunity exists, and by the time